Back to the UK now, and the Chancellor, Rachel Reeves, has been making her pitch to the financial services industry in her first Mansion House speech. It included a promise to rethink regulation of the sector and efforts to boost investment. Joining us now to discuss is Nigel Wilson, chair of the Canary Wharf Group, former CEO of Legal & General, of course, and a regular visitor to these Bloomberg studios. So very nice to see you once again, Nigel. You've also chaired, of course, the recent Capital Markets of Tomorrow report, looking at the challenges facing the city. So well placed to review Rachel Reeves and everything we got from Mansion House. How did you read her comments on rethinking regulation, Nigel? Because this is part of a push to perhaps refocus some of the regulatory bodies we have in the city around growth.
Yeah, I think the growth agenda came back. We had a sort of ideological diversion for the budget, and then we've gone back to the growth agenda, which is a good thing. And I think the upbeat message around growth has been central again, is actually what we should be spending our time on, because the economy is muddling through, growth's anemic, everybody's panicking about how they handle the NICS issues and the various other incremental taxes that have come through the budget. And we've got to get back to the bigger picture, which is how we're going to grow. And the fact that they're going to give the regulators the dual objective of delivering growth, I think is really positive.
And you think we'll get the balance right there, will we? Because of course,
I'm sure we won't get the balance right, but we're going to get the direction of travel right, which I think is what we haven't had for 25 years. And whether that's the water industry or the telecoms industry or the financial services industry, we have not got the growth agenda anywhere embedded in the regulations of all those industries, and that has to be part of the long-term growth strategy that we have as a country. We definitely don't have it right now.
Will the simple shifting or addition to those mandates of those regulators, though, be enough to encourage more risk-taking and thus spur the investment that Rachel Reeves is hoping that it will?
No. I think the culture of the organisations needs to change dramatically, because sometimes the messages at the top get diluted when they come to implementation. And I know we used to spend sometimes years trying to get a new asset class approved by the regulator for investing in the UK. And often, as a consequence of that, we ended up investing outside the UK in an asset class which already existed in America. And that's not a good outcome. And that was because they didn't have a growth agenda. They were excessively risk averse. And as a consequence of that, we took action which allowed us to deliver on a global thing the right outcome, but definitely not the right outcome for the UK.
And that takes us on to the pension activity that we've seen from Rachel Reeves then, this idea that you pool these pension assets together to make these mega funds, and maybe that increases some of the investment that we see from pensions into infrastructure projects in the UK, although not necessarily in the UK. So, Nigel, tell us your response to where we've got to on this.
Yeah, but not necessarily in the UK, because what we've seen is in LGPS, for example, Legal & General manage a huge amount of money for LGPS. 38% of their investments used to be in UK equities. It's now about 9%. So the first wave of consolidation, which we've seen in LGPS, didn't result in more investment in the UK. It resulted in entirely the opposite, which is a big decrease in UK equities. So, you give the necessary conditions, but it's not sufficient conditions.
So scale isn't everything. What else do you need?
Scale isn't everything. It's actually, we have to create the planning opportunities which allow us to have these investments, but also the risk appetite to want to do these things. America leads the way in lots of these asset classes, and they have some amazing companies, the Brookfields and Blackstones and Apollos and KKRs, who've been developing these assets in private markets, as indeed, JP Morgan and the other banks have. We haven't got that capability at the moment in the UK. So if we're not careful, the assets, people will invest in those assets, but not necessarily in the UK in those assets, which is what we saw over the previous 15 years in UK equities, with a decline from almost 40% down to less than 10%.
But isn't it always going to be the case that, comparing yourselves to the US is an extremely difficult thing to make the case for? How do you, what encouragements do, you're talking about the local government pension schemes as the changes that Rachel Reeves announced, but do pension funds need a mandate? Does it need to be very clear that they have to put X amount of assets
I'm in
UK?
favour of soft compulsion, which is...
What does that look like?
Yeah, which is a bit like auto-enrolment. People are encouraged to invest in things, and if they don't want to, they opt out. But we certainly should be setting targets or frameworks which allow them to invest more in the UK, so that over a long period, 10, 20, 30 years, we see more of these monies being flowed into risk assets in the UK as opposed to too much of the assets in cash and gilts, to be frank.
Why do you think they've stopped short of doing that? Because this was a criticism of the last administration as well, that they didn't mandate that the money had to stay in the UK, and it might be because, well, if you want best execution for future pensioners, you need to be able to invest abroad, but you could attach it to tax benefits and say, OK, put it in the UK and then you get these tax breaks.
Absolutely. And cash ISAs are probably the best example of that, where we give everybody a tax break for investing in cash. We're the only country in the world that does that. That's a £300 billion asset class. And imagine if we phased that out over time and got people to invest in other assets which are of greater strategic value to the UK and deliver better returns over the long term. That would be a good outcome.
I'm curious to know more about your view of this idea of setting targets. What's the ideal level for a target for investment in UK assets? What's going to do enough to spur the growth that then creates the business case behind it?
Well, if you look at DC pensions, which was kind of where Rachel was talking about, and I think much of it was a good speech by Rachel, I thought, and I've now read it twice and listened to it last night as well. The challenge in DC, it's growing very quickly. Most people invest in the default fund. It's the middle one on the first page in the middle box, and people tick that, and they very rarely change from that. So the default fund can be used as a vehicle for nudging in the right direction. And I would say, let's give UK infrastructure a 5% allocation within the default fund. And that's an easy thing. It doesn't
need to be huge.
What?
It doesn't need to be a huge percentage.
It doesn't need to be huge, and it doesn't, everybody being very weird about it being non-competitive and all the rest of it. We've got a huge infrastructure deficit. How are we going to fill it? Is actually get people to be nudged in the right direction. In the same way that young people should be investing in young companies. Their friends and are setting up these new companies, and maybe have a 2% allocation for that. Again, not massive allocations.
And why are those things not there already then, Nigel? Just remind us. It's been a long. We've spent a long time getting to this place.
I've failed miserably is one of the reasons they're not there. I've tried very hard for 15 years to get this to happen in the UK, and there's always been a reluctance to doing it. But now we can see there's no growth. There's a tiny amount of growth.
And it's been about risk aversion, has it, that those things weren't there?
Well, it's sort of an ideological objection to actually some soft compulsion. And that I think is the wrong approach when there's such an urgent need in the UK for this real money to make a difference to everybody's lives. And everybody thinks it's a good idea, but you've got to give a bigger nudge than we've been giving so far. And we're not saying go wild and reckless and do all things. That's why the growth objective is so important. Then the regulator can approve these asset classes much quicker, and we can see much greater growth in these businesses in the UK.
I want to kind of ask you, for want of a better word, about the vibes, right? Because I'm sensing you're quite positive about what you heard from Rachel Reeves last night. Good ideas, moving us in the right direction. Yeah. That's contrary to the narrative that we've had since the budget, particularly from business groups. They weren't happy about employers' national insurance contributions going up as well. Do these things cancel each other out?
I'm not sure they cancel them out from a business point of view. I think people are still very grumpy about the budget, and that's going to mess up a lot of business plans and a lot of change.
Are you seeing that with people looking at Canary Wharf, for example?
Not really looking at Canary Wharf, but I think as I travel across the country and meet lots of people, I think that's definitely the case. The direction of travel was good last night, and talking to the Treasury as well, which I did, was they think the speed of travel is going to be okay, but are we doing enough fast enough? I think the answer to that is no. But the direction of travel is definitely better than what we saw in the budget.
And on the big picture questions. Nigel, let me ask you, so we're coming towards the end of this year. We know that next year is going to be, to some degree, of our own making, but here in the UK, but to some degree dictated by others. And we have a return to the White House in the United States that will have a big impact on so many people's lives and finance in many places. Do you think that the growth plans in the UK are sort of Trump-proofed? Are you watching with anxiety what might happen?
I think everybody's got to watch with a bit of anxiety as to what might happen, because there's a lot of contrarian approaches to solving problems that are going to happen, and there's some very oddish appointments that have been made already, which you guys have been talking about. And yes, we'll see some compromise on tariffs, but there's still tariffs, and we know that there's all sorts of negative consequences as a part of that. The whole defence and defence spending and the role of NATO is going to have a big impact on Europe. I hope personally that again, and Keir Starmer said that, and Rachel said that, and indeed Governor Bank of England said this, let's get together and be closer to Europe. Brexit was a mistake, but actually let's move forward and figure out how we can develop better partnerships with the rest of Europe. And Trump may prove to be the catalyst that makes that happen. And so that may be the positive outcome of all of this, is that we'll all be treated in a certain way, and that actually, as a consequence of that, we may all get together. Because the German economy is in a mess. The French economy, I think, is in a mess. The Italian economy's got no growth whatsoever. Some of the smaller countries are doing reasonably well, but net, it's a pretty miserable show. And Europe's going to muddle through as well next year. The UK is going to muddle through. We've got to work together in partnership and figure out how we can grow together and how we can invest so much more. Because we've got the capital. It's all sitting around. We've had regulators being overly risk-averse, which has ended up with companies being overly risk-averse, our politicians being risk-averse, and the outcome of this excessive risk aversion is low growth. And that's been a terrible outcome for us as a society.